All right, so now let's talk about when we can't collect on those customer accounts, right? You mentioned we hope to, that's why we're extending the direct line of credit. We hope to make those accounts into cash, but of course it just may not happen, right? We hope this will happen. We will collect that cash, but there's just an inherent chance of default whenever you extend credit to anyone. So what FASB says is that public companies must estimate for those uncollectible accounts, for uncollectible accounts. Okay. And you might say, well, why? Why would they require that? Well, two reasons. We mentioned one in the last video. Conservatism is one of those foundational assumptions that accounting rules are based on, which says that we should always seek to make sure that we're not overstating assets. Don't overstate, not to overstate assets, and do not overstate income. Right? And you can see if we don't make some sort of estimate, our assets would be overstated, specifically AR. Our income would be overstated because we recorded sales revenue, right? We recorded an increase to AR and an increase to sales revenue when we made the sale on the account. So if we don't make some sort of provision for the default, then your assets are overstated and your revenue is overstated. So we would violate that core concept of conservatism. So that's why FASB says, yeah, you gotta estimate. Remember, FASB is that private accounting board that creates accounting rules for the profession. All right, the other reason is we have the matching, also called expense recognition principle that we learned about in chapter 3, right? Which says to match expenses to the revenue in the same time period. Basically, it took certain costs in order to generate that revenue. So make sure that you are matching those costs in the same period, same time period. So here was our journal entry to record the sale on account. Right now, your assets are too high, your revenue is too high. You're going to see that when we make the estimate, the journal entry to estimate for uncollectible accounts is to debit bad debt expense. Sometimes it's called uncollectible expense. Let me see. They use bad debt expense. Okay. So we increase bad debt expense. That fulfills the matching principle. We're recording an expense to match against the revenue in the same time period, because this is an adjusting entry made at the end of the year. So we'll say the end of the year. Maybe this sale happened in, it doesn't matter, April 1st of 2022, right? In the same period, we're recording the expense to offset against the revenue. So we're fulfilling that matching principle. Also, by increasing an expense, we bring down our net income. So we're making sure not to overstate income. The next account is a new account. So we have to have a credit offset for this debit, right? Allowance for doubtful accounts. I'll abbreviate it ADA. Okay, ADA is a new account for us. So let's kind of do a little side discussion about that new account. ADA. Okay, it's a contra account, specifically a contra asset account, which makes sense, right? Accounts receivable, that's an asset. So this one is a contra asset, which means it's going to have a normal credit balance, opposite of assets. And it will also appear on the balance sheet, just like your other contra asset did, accumulated depreciation. In terms of the presentation, right? So if we were to look at our balance sheet under the assets section, right, you would have cash, normally followed by AR. Now, right after AR, you're going to have that contra account. Just like we did with equipment in chapter 3 and 4, right? Equipment less accumulated depreciation, that gave you net book value, right, for equipment. So what is the difference going to be called between AR and ADA? That is called net realizable value. Okay, which I'll also abbreviate. There's a lot of long terms in this chapter, so I'll abbreviate that NRV. Okay, which is the difference of AR and the allowance you have created to estimate your uncollectible accounts. So since we're subtracting from the asset, we're bringing our asset down, right? Which means that we are going to follow conservatism by making sure our assets are not overstated. Okay, so that's the theory about why we're going to have to do this estimate, right? FASB requires it. Why? To fulfill these two core, GAAP concepts. Here's the journal entry to record that estimate. Here's how it's going to look on our financial statements. Okay, we're going to get into how to calculate the amount in the next video.